The winds of change are sweeping across the global financial landscape, ushering in a new era of synchronized monetary easing. As central banks around the world pivot to support economic growth, a harmonious melody of rate cuts is set to resonate through the financial markets, echoing the collective concerns over fading inflation risks. At the forefront of this choreographed dance is the European Central Bank, poised to lead the charge with an anticipated interest rate reduction on Thursday. This move is expected to set the stage for a similar act by the Federal Reserve the following week, signaling a shift in the global monetary cycle towards a more accommodative stance. The ECB's rate decision, occurring mere days before the Fed's anticipated move, underscores the growing synchronization among advanced economies as they navigate the delicate balance between economic growth and inflation management. Like a well-rehearsed orchestra, central banks are fine-tuning their policies, responding to the changing economic rhythms with a newfound unity. In the eurozone, the easing of a key measure of wage growth during the second quarter has emboldened policymakers, providing them with the confidence to press forward with rate cuts. Meanwhile, on the other side of the Atlantic, a highly anticipated U.S. consumer price report, due on Wednesday, may offer the Federal Reserve the reassurance it seeks that inflation pressures are stabilizing, following the recent data showing a slowdown in U.S. hiring. For investors, the question looms large. Do these rate reductions herald a deeper easing cycle, one that not only removes constraints on major economies but actively stimulates their growth? The prospects for economic expansion will be a focal point when ECB President Christine Lagarde addresses the media on Thursday, particularly in light of the recently released data showing weaker-than-expected second-quarter growth in the eurozone. The ECB's Governing Council is believed to favor rate adjustments during meetings, accompanied by newly produced quarterly forecasts, making a further cut in December more probable than one at their next gathering in October. This strategic timing ensures that policymakers have the most up-to-date economic projections at their disposal, enhancing the precision of their monetary maneuvers. Beyond the transatlantic tandem of the ECB and the Fed, the global monetary symphony extends its reach across continents and economies. From the Bank of Canada's Governor Tiff Macklem's speech in London, to the highly anticipated Chinese inflation data and the rate decisions spanning Pakistan to Peru, the world's financial stage is set for a crescendo of synchronized action. Closer to home, Fed officials are entering a blackout period before their pivotal meeting, a temporary silence that amplifies the anticipation. Yet, in the lead-up, Governor Christopher Waller struck a resolute tone, asserting the importance of initiating rate cuts and expressing an open-mindedness toward the potential for a more substantial reduction. The current batch of data no longer requires patience, it requires action, he declared, capturing the urgency that now permeates the central banking community. The labor market remains a focal point for Fed policymakers as price pressures have cooled, with the August CPI report expected to show a modest 0.2% rise in core inflation for a second consecutive month. On an annual basis, the core CPI is projected to have increased by 3.2%, matching July's figure, the smallest since 2021, further cementing the narrative of moderating inflationary forces. As the global economic symphony unfolds, the United States will contribute its own melodic lines through a series of data releases, including August producer prices, weekly jobless claims, and the University of Michigan's preliminary September consumer sentiment survey. Each note adds depth and texture to the overall composition, informing the decisions of policymakers as they navigate the intricate interplay between economic growth and inflation management. Turning our gaze northward, Canada's national balance sheet data will shed light on household net worth and the debt-to-income ratio in the second quarter, providing valuable insights into the financial health of Canadian consumers, a crucial component in the harmonization of global monetary policies. China, however, takes center stage, with a flurry of economic data expected to highlight the ongoing fragility of domestic demand. Consumer inflation is forecast to tick up slightly to a still anemic 0.7% pace, while factory gate prices are anticipated to continue their downward trajectory. The crescendo of data releases culminates at week's end, with growth figures for industrial output, retail sales, and fixed asset investment all likely to have moderated in August, compounded by a projected double-digit decline in property investment for the fourth consecutive month. Elsewhere, Japan's economic rebound in the second quarter may receive a modest upward revision, buoyed by solid capital investment data for the period. India's August inflation data, scheduled for Thursday, could tip the Reserve Bank of India toward an October rate cut, according to Bloomberg Economics, as price growth is expected to slow for a second consecutive month. The global trade symphony will resonate through data releases from China, India, Taiwan, and the Philippines, while Australia will offer insights into consumer and business confidence on Tuesday. On the monetary policy front, Pakistan's central bank is widely expected to orchestrate its third consecutive benchmark rate cut on Thursday, with Uzbekistan's central bank also set to announce its policy decision on the same day. Across the English Channel, the United Kingdom's wage numbers on Tuesday are likely to reveal weaker pay pressures, albeit with the annual pace of increase still more than double the Bank of England's 2% inflation target. Wednesday's monthly gross domestic product data is anticipated to show a modest increase in July, pointing to a lukewarm start to the third quarter. Furthermore, the BOE will release its latest inflation expectation survey on Friday, providing insights into the public's perception of price pressures, a critical factor in shaping monetary policy decisions. Turning our attention to the eurozone, industrial production numbers from Italy, Spain, and the region as a whole will offer a glimpse into the economic condition as it entered the second half of the year. Based on the performances of Germany and France, whose data was released on Friday, it is likely that the broader economy was on a weaker footing. In Germany itself, Finance Minister Christian Lindner will present the country's 2025 budget to Parliament on Tuesday, followed by remarks the next day by Chancellor Olaf Scholz and other government ministers, further illuminating the nation's economic trajectory. Across the continent, inflation numbers in Norway, the Czech Republic, and Sweden will be closely watched by central bank policymakers as they assess the lingering strength of price pressures and calibrate their monetary responses accordingly. Southward, traders will cast their gaze upon Egypt on Tuesday, anticipating a potential sixth consecutive month of slowing inflation. After peaking at 36% in February, inflation has since fallen below 26%, thanks in large part to a massive international bailout, a testament to the global interconnectedness of economic fortunes. Similarly, a report on inflation expectations in South Africa on Thursday will inform the decision-making process of the South African Reserve Bank, which anchors its policy guidance on 2 years ahead numbers. A drop toward the 4.5% midpoint, where the central bank prefers to anchor expectations, could provide the impetus for its first rate cut since the height of the pandemic, a harmonious note in the global monetary symphony. Aside from the ECB's anticipated rate cut, a couple of other central bank decisions are on the horizon. On Thursday, the National Bank of Serbia may maintain its rate at 6% after inflation rose in July for the first time in more than a year, defying the broader trend of moderating price pressures. The following day, the Bank of Russia will command attention as it weighs the continuation of its tightening cycle, having hiked borrowing costs by 200 basis points in July. Wednesday's inflation data from Russia may reveal whether price pressures have passed an annual peak, informing the central bank's decision. Finally, the International Monetary Fund is set to complete a review of Ukraine's economy and finances in the coming week, announcing whether the lenders' board should approve the next tranche of a $15.6 billion loan for the war-torn country, a reminder of the global financial community's solidarity in times of crisis. Latin America's 3 largest economies will also contribute their voices to the global monetary chorus, with august consumer price data shedding light on the region's central bankers' recalibration of monetary policy. On Monday, Mexico's National Statistics Institute will likely report a moderation in inflation to 5.05% from 5.57% the previous month. While the nation's cost of living has been propelled by soaring prices of services, fruits, and vegetables in recent months, the expected slowdown may provide the central bank with more room to consider another rate cut later this month, bolstering a weak economy. The next day, Brazil is anticipated to report a decline in inflation from the 4.5% ceiling of the central bank's tolerance range. While any decline would provide limited relief, policymakers face pressure to lift borrowing costs in September due to price risks, including increased public spending, robust economic growth, and a depreciated currency. Finally, Argentina will release its consumer price data on Wednesday, as President Javier Milei's administration touts progress in its efforts to tame the cost of living. Monthly price increases have indeed waned from a staggering 25.5% in December, when Milei's government took office, to 4% in July. However, annual inflation remains well above the 200% mark, a sobering reminder of the challenges that lie ahead in the nation's quest for price stability. As the overture of synchronized global monetary easing reverberates across the financial world, a harmonious blend of rate cuts, data releases, and policy decisions coalesces into a powerful symphony. Central banks, once dissonant voices in the cacophony of economic uncertainties, are now conductors of a unified monetary score, guiding the global economy toward a more sustainable crescendo of growth and stability. At the heart of this composition lies a delicate balance, the interplay between fostering economic expansion and reining in inflationary pressures. Like skilled musicians, policymakers must navigate the nuances of this equilibrium, adjusting their monetary instruments with precision and foresight, ever mindful of the intricate melodies that shape the global financial landscape. The upcoming rate decisions by the European Central Bank and the Federal Reserve, while commanding center stage, are but singular movements in a grander opus. The true beauty lies in the tapestry woven by the collective efforts of central banks worldwide, each contributing its unique voice to the harmonious whole. From the easing of wage growth in the eurozone to the moderating inflation pressures in the United States, from the fragile domestic demand in China to the robust economic growth in Brazil, each economic note adds depth and richness to the global monetary symphony. As investors, analysts, and policymakers alike attune their ears to this intricate composition, they must embrace the interconnectedness that defines our modern financial world. No longer can decisions be made in isolation, for the reverberations of monetary policy echo across borders and continents, rippling through the intricate web of global commerce. In this era of synchronized easing, the success of the global economy hinges on the ability of central banks to harmonize their efforts, to strike the right chords at the precise moments, and to navigate the ever-changing tempos of economic cycles with unwavering precision. The coming weeks and months will be a true test of this harmonic prowess, as the world's financial maestros take their places on the podium, batons raised, ready to conduct the next movement in the grand symphony of global monetary policy. Will the melodies of rate cuts and accommodative stances coalesce into a resounding crescendo of economic revival? Or will dissonant undercurrents of lingering inflationary pressures and geopolitical tensions threaten to disrupt the delicate harmonies? Only time will tell, but one thing is certain. The global financial stage has been set, and the world eagerly awaits the debut of this unprecedented monetary opus, a composition that will resonate through the annals of economic history, shaping the fortunes of nations and the trajectories of economies for years to come. In the end, it is not the individual notes that will define this era, but rather the collective symphony, a masterful blend of coordinated policies, data-driven insights, and a shared commitment to fostering a more prosperous and stable global economic order. As the curtain rises on this grand performance, let us embrace the beauty of this harmonious endeavor. For it is through the unity of purpose and the synchronization of actions that the true power of monetary policy will be unleashed, ushering in a new era of global financial cooperation and prosperity.